What's up guys, Ben here and welcome to Motivation to Invest. Now I've received a number of questions from you guys regarding the delisting of Chinese stocks or the potential delisting of Chinese stocks. So the House of Representatives has recently passed a bill which could potentially delist Chinese stocks. Now there's been a lot of fear of this situation and many of you guys have messaged me and asked for my thoughts. So in this video I'm going to give you guys the facts, my rational thoughts and an action plan for this issue. I'm going to reveal what has happened, why it's happened and what you guys can do for your portfolio, as I know many of you guys are invested into Chinese stocks such as NIO, Alibaba, Xpeng and many more. So firstly, what's happened? So according to the Wall Street Journal, the House of Representatives has approved legislation that would likely lead to the delisting of hundreds of Chinese companies trading in the US. So how many Chinese companies currently trade on US exchanges? Well, over 210 Chinese firms with a combined market capitalization of around $2.2 trillion are listed on the major US stock exchanges. So what's the purpose of this bill and why was it passed? Well, the purpose is really to make foreign companies comply with US and Western accounting standards. They want the Public Company Accounting Oversight Board, or the PCAOB, to oversee the auditing of their financial records if they want to raise money by selling stocks or bonds in the US public. So this could actually be a good thing, because the reason this bill was passed was to protect investors such as me and you guys. We want to know when we're investing into a company that the numbers the company says they produce are actually real.
I want the truth! You can't handle the truth!
Now, Chinese companies do have a reputation for creative accounting and sometimes outright lies. A popular example of this was a company called Luckin Coffee. This was nicknamed the Starbucks of China. It was a high growth stock, a lot of momentum behind it, a lot of exuberance behind it, and then suddenly it was delisted. Less than a year after it went public on the Nasdaq. The company was found to have fabricated as much as $310 million in sales. So that is a major issue and something we do need to be cautious of when investing into Chinese companies. However, I do also think that there's another reason why this bill has been passed, and that is to bring China back to the negotiating table. Like it or not, the US and China are the two largest economies and they're going to butt heads sometimes. They need to work together and allow capital to flow from country to country in order to both prosper together. So why does it even matter if certain stocks get delisted? Well, this matters for a variety of reasons. First is their access to capital. So if a Chinese company is delisted from a US exchange, then that will limit the amount of capital which flows into that company. Access to the US capital markets is immensely valuable to these Chinese companies, with billions and trillions of dollars flowing into Chinese stocks such as NIO and Alibaba. The second major issue of a stock being delisted is reputational damage. So if a stock was delisted, there must be a reason for it to have been delisted, and thus this will put off any future investors, even if the stock is relisted on smaller exchanges such as an OTC or over-the-counter exchange. And then the third and final point is liquidity issues. So many hedge funds only like to invest into stocks with high liquidity. This means they can buy and sell their stocks easily. If a stock has liquidity issues, then this will affect the company's valuation. Now, this bill that was passed could mean Chinese companies could be delisted within 3 years. Now, do I think it's likely that these Chinese stocks will be delisted from US exchanges? Well, personally, I don't think it's very likely. I put it between 1 and 2%. Also, as there's a 3-year period, that means worst case scenario, in 3 years, this will happen, not right now. But there's some other reasons why I think it's quite unlikely that these stocks will get delisted. So the first reason is the US investment into Chinese companies. So there's a vast amount of hedge funds and pension funds with ties to the government who are invested heavily into Chinese companies. Everyone from Ray Dalio's Bridgewater Associates, the world's largest hedge fund, which has large stakes in companies such as Alibaba, to even active ETFs such as ARK Invest, which has investments into many smaller Chinese companies. So according to this report by Goldman Sachs, the bank analysed the latest regulatory filings for 833 hedge funds with $2.1 trillion in equity positions. Their medium China exposed stock had a 2.7% of market cap, which was owned by these hedge funds at the start of the third quarter. And that position actually rose to 3.4% at the start of the fourth quarter. Now, this was a report from 2019, according to Goldman Sachs. So basically, these hedge funds over the past few years have actually been increasing the amount that they're invested into Chinese companies. They've not been decreasing it, they've been increasing it. And there's great reasons for this. China has the world's largest population of 1.42 billion people. They have a growing middle class population. They were also one of the least affected countries by this whole global issue. And there are some great innovative companies in China. But there's another reason. So if the US decides to do a major blow to Chinese stocks, then they could do the same to US companies. And then it becomes a vicious circle and a battle. So many US companies actually rely heavily on their revenue in China. So here's a list of US companies here with large exposure to China. So first we have Yum China with 100% revenue exposure in China. This owns brands such as KFC and many more eating outlets. Then we have Wynn Resorts, the great hotel company that has 75% revenue exposure into China. We have Qualcomm, we have Las Vegas Sands, we have Nvidia. Many more companies have a large exposure of their revenue to China. So if the US fires a shot at China, China will fire one back, and at the end of the day, that will affect the man on the street in the US who is the guy that votes for that government. So to me, it just doesn't seem likely that they will really want to push too hard on China, especially now we have a Biden administration. But as I'm a firm believer that no matter what happens in a situation, you should be ready for anything, because unpredictable things happen in the stock market and maybe the stocks will get delisted. So the real question is, what can you guys do to mitigate your risk? Well, firstly, and this is really obvious and simple, I know you guys are going to go, Ben, of course, is just diversify your portfolio. Diversify it across industries, across stocks, and across countries. Don't be too heavily exposed to one country, especially China. Now, the second way is you can actually check which company is the independent accounting firm which oversees the company. Who is their auditor? For example, if you dive into the investor relations report for any Chinese stock, in this example we'll use NIO because I know a lot of you guys are invested into NIO. So if you scroll down to their frequently asked questions in the resources section, you'll see that NIO stock is audited by PricewaterhouseCoopers, or PwC. Now, this is one of the big four accounting firms, along with Deloitte, EY, and KPMG. Now, this bill was passed to ensure that accounting firms are certified. So if you head to the PCAOB website, which is pcaob.org, under the resources tab, you can actually type in the name of the auditor from the Chinese company which you want to check out. For example, this case NIO, I typed in the name of the auditor, which was PwC, with the relevant region. Unsurprisingly, it came up that that auditor was actually certified with the PCAOB. So that does lower the risk slightly, but it's still not a foolproof way of ensuring that the numbers that the company says they're producing are actually true. And now that might seem counterintuitive because you're saying, Ben, because an accounting firm's job, an auditor's job, is to ensure that the numbers the company is producing are real and genuine. However, in the past, we've seen certain companies who are actually audited by the big four accounting firms actually producing still some false numbers.
I want the truth! You can't handle the truth!
So I'll give you an example of this. So Luckin Coffee, I mentioned these earlier, the Starbucks of China. They were delisted. They were found to have fabricated over $310 million in sales. Well, the auditor for the company was actually Ernst & Young, and they were also certified by the PCAOB. Now, Ernst & Young, you may have heard of these guys. They seem like a very reputable company. But how come they missed this? Well, they stated these details were from past audits, and there was a complicated issue with it. However, I think there's another reason, and I actually watched a documentary on this. So it seems that many of these major accounting firms have a really cozy relationship with businesses. So let's say this company is paying this auditing firm a heap load of money in order for them to audit their accounts. If that auditing firm starts asking too many questions or just causing problems for that company, then what can the company do? Well, the company can say, okay, we're going to go with a different auditor. We're going to go with one of your competitors.
There's someone else. I've fallen in love with someone else.
Now, this actually means that these auditors could have personal interest in order to not maybe delve as deep as they should into certain companies' numbers. Now, I'm not saying they're all doing this, but it is a risk for investors. So what are my final thoughts and what should you guys actually do with this situation? Well, my final thoughts are anything can happen in the stock market. So you need to be prepared for any eventuality. And the best solution really is just to diversify across stocks, across industries, and across countries. Let's say you only have 1 to 2% of your portfolio invested into Chinese stocks. and let's say a very unlikely scenario happens and that they all magically get delisted from the stock exchange, then you've lost 1 to 2% of your net worth. That's not a major issue, and that same thing could happen to a US company which could go bankrupt. So the key thing really is about awareness of your portfolio. But personally, I do think it's very unlikely, and the China opportunity is just too great to miss in order to not have any exposure to there at all. Just look at all the major hedge funds. They're increasing their exposure into China, not decreasing it. But it all depends on your personal preference and risk tolerance. If you like, you could just stick with US companies. I'm personally diversified internationally. I have majority of my investments in the US, but I do have some key stocks in China, and they're fantastic companies. They've offered me fantastic returns so far. So that's my thoughts on this whole situation. What are your thoughts? Please do comment those in the comments below. I'd love to hear from you, and I'll join in that discussion down there. And if you guys found some value in this video, then feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you're new around here and you still haven't subscribed yet, what are you waiting for? Go ahead and hit that subscribe button. Turn that notification bell on. Only if you want more investing tips and exclusive stock market picks, which I'm personally investing into. In addition, be sure to claim your 4 free stocks from Webull if you're in the US. I've got a link in the description. This is a limited time off. I believe they're stopping it around end of December, so just check out the link below. If you're from the UK, feel free to check out the link for eToro. You can sign up for an account there, or even Trading 212, which offers a free stock. I'm personally invested across multiple investing platforms as they're all completely free, and it actually diversifies. Also, certain platforms have certain stocks that others don't. So it definitely makes sense, and I don't think these offers that these companies are doing are going to be around forever. So definitely take advantage while you still can. Free stocks. With that being said, I hope you guys have an incredible day, and I'll see you in my next video. Invest safe.